So good afternoon and welcome to the Aura Energy Investor Webinar. I'm Jane Morgan, the Investor and Media Relations Manager for the company. Today, Managing Director and CEO Peter Reeve will be presenting the company's recent competitive advantage and peer comparison presentation, which will be followed by a Q&A session. Today, I'm joined by Aura Energy's MD and CEO, Peter Reeve, and Curzon Head of Uranium, Bram Vandelis. Peter, I will now hand to you to run through the presentation.
Thanks, Jane. Thanks, ladies and gentlemen, everybody, for coming onto the call. As we progress through this, the early stages of this uranium cycle, and we see ourselves as this near-term uranium producer, more and more we need to sell the story to people of the competitive advantages we have over many of the other promising uranium development companies, and we think we're very well placed. So this presentation pushes that a bit more, and I'd like to welcome Bram. Bram and I have worked together for quite a few years. He's based down in Cyprus at the moment, normally London. So thanks for getting up so early, Bram, and coming onto the call. When we look at Aura's competitive advantage and you look at the peer group, you really want to ask who can be the first to cash flow. And the project attributes for a fast development are you want the capital cost to be low, the operating cost low, a decent uranium price as threshold to commence production, and also that time to production to be reasonably short. And you want to have a look at the key development permits and the ability to expand the production, the ability to expand the resource. So when Aura looks in the mirror, we believe we tick all the boxes. Of course, I'm going to say that I'm the MD of the company, but we tick all the boxes. $74 million US CapEx is very competitive. A C1 cash cost of $25 a pound. Late 30s really for that threshold price before we can start to say it's time to produce, time to start the construction. And we can be in production around about 18 months from the time we're financed. We have the environment permits and we have the development permits. It's really, really important. They were very hard to get. They're very expensive. It takes a lot of trust in the government to get those. And we have both those permits. So we're fairly unique as far as that goes. We've studied expanding the project to 3 million pounds per annum. And that is definitely something we will look at. Further drilling to expand the resource it will be underway soon as well. Just in terms of summing that up as an investment highlight slide, I mentioned the low CapEx and OpEx. Importantly, we just updated our DFS capital cost in August. So of all the peer group, we're probably the only one to have done that. So COVID conditions, new world situation, we've got a number. It increased from about 62 to 74, so it was a modest increase, but it is a current number, and that's important. The recent work we did as well on the resource, we got another 10% out of the resource very easily from some inclusion of drill holes in a certain part of the ore body. And also, again, with Bram on the phone call, we've got this facility with Bram's organisation, which can give us up to $20 million of project offtake debt financing. And that's very important as that one of those building blocks to start that position towards getting that whole 74 funded. We've got a loyalty rights issue with a record date 22nd of October, and you receive details of that fairly soon. So again, expansion of the resources is strong. There's a short time frame to development, and we've got these upsides to production, which is important, and the ability definitely to do more of the offtake financing. Why, people have asked, why do we have a low CapEx? Why do we have a low OpEx? How do we compare to the other peers? We are a unique project, geologically, how that occurs. And this leads to all of those ticks on the left-hand side. We don't have drill and blast. We don't have crushing and grinding. We just have a simple washing facility. The ore is very shallow, and the beneficiation step we get cuts the whole volume of the material by about 80%. So the expensive parts of the plant, the footprint is very small. So that gives all of those benefits that we talk about. You can see from other uranium projects, they can be a lot deeper. They do have crushing and grinding. Not many people have the beneficiation step that we talk about. So it's just a natural geological element of our project that we can do that beneficiation upgrade, but it's very, very positive for us. When we put all this up as a comparative table, it's clearly a busy slide, but it's an important slide, because if we believe we are one of the first to be into production, we've got to stand up well against the competitors. I think what you want to look at here is our market capitalisation, which talks to the value generation in this cycle, and it's very low. The status of our study, it's a DFS, so we are very well advanced relative to others. The permitting is important. Again, we've got a step up on a number of the competitors there. Some of them do have the permits, but Aura is there already. We have this recent update on the capital cost. On the resource, we have expansion potential. It's always an expedition for Aura to go into the Sahara Desert and drill, so we try and keep that to a minimum. But when we now are starting to get financing, then to start to look at both in resource expansion and new elements in the region for expanding that resource, we're going to look at that in some detail. And then you can see the life of mine CapEx. It's important to contemplate both the initial CapEx and the sustaining CapEx. And I will point out that companies that are in situ leach situations do have what I call, I'm a metallurgist from background, they do have repeat development capital. It's not necessarily sustaining. So Aura is a mineral project. We'll spend our CapEx. We'll have modest sustaining capital on a yearly basis, but after that, no substantial sustaining capital needs to be spent. And you can see our operating cash cost and our all-in sustaining cost is very competitive relative to the peer group. And the enterprise value, again, just to point out, very cheap relative to many of the competitors. So it's a table you can spend a lot more time on. I'd encourage you to look at it in your private time if you really want to understand the sector, and add your own companies to that as well. It's a good slide, and it's important to show that Aura is a long way ahead of a lot of these other companies. Just reiterating, you can see the map on the right-hand side. We're in the northeast corner of Mauritania. It's in the Sahara Desert. It's a desert evaporative type of deposit, so it's between 1 and 5 meters deep. That's why I've got a great deal of confidence that over time, a lot of the 56 million pounds in the inferred resource will be mined, because we don't have any deep ore bodies. We don't have cutbacks that require the trap mineralisation. Pretty well most of the mineralisation there we should be able to access. Payback for the project's about 4 years. So once we're just looking at the marginal cost for getting the capital, once we're looking at the marginal cost post-payback of what each tonne means to the mill, we'll be able to pick up a lot of that material. Free digging, I'll show you a slide in a second. And into the leach, we get about 92%, and overall recovery is around about 88%. I've mentioned the low CapEx and OpEx. All-in sustaining is under 30. And it's very important that of the 56 million pounds for the 15-year mine life we have outlined, we're only using 12.4 million pounds of that resource. This is where we believe we will be able to increase that 12.4 over the life of the mine and use up a lot more of that 56. We are in a desert location. We don't have neighbours. We don't have churches over the top of our mine. We don't have villages nearby. We don't have people. It is a remote location. That excavator's dug that trench. So that shows and demonstrates the free digging nature of the ore body. And you can see the small rocks on the side of the trench there. If I were to have one of those in my hand and hit it, it would be bull dust in a moment. So it just shows you how soft and friable. So just reiterating that point we've made about the no drill blast, the no crushing, grinding, driving these lower costs. And more recently, we've had some really excellent results in water drilling. We've released some of that already, and that's continued. It's been very, very positive, and we feel very confident about the amount of water we have for the project in that location near the plant. We've always realised that as we expand the resources, the measured and indicated component of the ore body, that we would increase the pounds. Yeah, we don't want to have a 30 or 40 year mine life out there in the Sahara. So we studied 2 to 2.5 years ago what it would take to expand the production if that resource was increased. And 2.5 to 3 million pounds is a good number to look at. You know, the capex, we believed at that stage would be around about 50 or 60 million US dollars to treble the size. And the layout of the plant has always been such that we have left space for additional washing trommels at the front end of the plant, additional space for some more leach capacity, and the expensive back end of the plant will already be rated at 3 million pounds per annum when we start production. So that's always been a 3 million pound unit, not 1 million pound for what we were going to produce. Just to explain to people who are interested how the washing works, you can see the yellow uranium and the grey, let's call it the coarse weathered granite. We put that mix, it's a sandy, gravelly mix, into a trommel at 120 tonnes per hour. It's a simple, dirty slurry you'd see in any gold plant. And then that drops out over a screen. The screen sees most of the uranium go through the screen and very little of the mass. And that holds most of the carnotite, most of the uranium mineral. And the rest, you can see the coarse weathered granite goes straight back out, will be going back as backfill immediately into the pits. So it's a very simple process. We've tested this broadly across the ore body and in each of the vertical composites in all the drill holes, and it's consistent. In fact, we've had very, very high beneficiation levels, more than what we've assumed. So you can see from 120 tonnes per hour into the trommel, there's only 25 tonnes per hour going into the leach plant. And that drives this small footprint, drives the small capex, and frankly drives lower reagents, lower power, lower labour. It cascades into a number of really good positives if you're trying to build one of these things. The upside, as I mentioned, is to get this measured and indicated number higher within that 56 million pounds. And also, when resource estimators do their estimates, they like square boxes. They don't like amoeba-shaped figures. So we are going to get out there and drill the edges of all these nice square boxes the resource people have drawn for us, and make sure we can get more pounds out of that. So that's really, really important. Also, there was a high-grade target in harder rock some years ago that we had intercepted, but we've never gone back to test it. And we will go and test things like that, particularly when we're closer to production. The resource itself, the 56 million pounds in an area called Hippolyte South, we believe is open. We've done a little bit of work down there, but not enough. There's some very good radiometric anomalies that we believe we can look to see if there's more uranium there. So there's a number of areas where we believe there's exploration upside. Some of the activity, we've been busy since the first capital raising, and probably most illuminating, exciting, whatever you want to call it, is the water drilling. To find water gushing out of wells in the middle of the Sahara Desert is akin to finding gold in the Archean greenstone belt around Kalgoorlie. So it's been quite fascinating, and they've been excellent water flows. So as I said, we found a very, very large zone. It's within 20, 25 kilometres of the plant site. That's what we anticipated as a part of the CapEx. estimate that we put together. So everything's worked out well. And, and we've found it in several holes. So it's not just a one-off benefit. So that was an extension of the program we did in 2019. Yeah, and the results have been very, very positive. So we've got very, very happy water drillers out there, because water drillers like to find water, and they've had plenty of it. So we'll be posting some videos, some updates on that soon, and we'll be posting some videos of it. They're quite fascinating. It's just as fascinating to see the Sahara Desert as it is to see the water gushing out of the holes. But where we sit is we've got a granite bowl underlying, a sandy top, and that granite bowl we've always believed held water, and now we've had the proof in the theory there. We also are continuing some study work on lowering the operating costs. We've publicised this previously. We're getting through that program. We're just starting to report on it. And some part of that there's a few parts of lowering the operating cost there. And one part of that is by a vanadium byproduct credit. So there is vanadium in the carnotite. There is vanadium outside the carnotite, which will all go into leach and get recovered. So we'll need to put a small facility in to recover the vanadium, and that will give us a very good cash credit, which will lower the operating costs for the already low operating costs a bit more. And we are continuing to get, and are just about to report on, a net zero emission study undertaken by Wood PLC out of South Africa. So that's the end of that part of the presentation. Whilst I have Bram sitting there, maybe we can just talk about the financing that we put in place recently. So we've essentially got a $10 million facility, which can be expanded to 20 million by mutual agreement. And the facility will be used as part of the construction, but obviously when we get all of the financing together as one package. So Bram, I don't know if you want to make any comment generally about the facility before we get into Jane's questions that I know she's got there, but you might want to add some words to that.
Yeah, for sure. Well, first of all, good afternoon, everyone. And good afternoon, Peter. Thanks for bringing me onto the call. Regarding the facility, yes, well, I mean, we're obviously very happy to work with you guys. We've been talking about this for a number of years. You and I have worked together on this for a better part of 4 or 5 years. And we're very happy to support Aura with this financing facility, because ultimately for us as a physical trader of natural uranium, we want to work with projects where we can see a near-term production and sort of a near-term ability to produce uranium that we can then offtake. And this facility works really well in that respect, in the sense that we are more than happy to provide some pre-export financing or late-stage project financing that will help you guys get there on the 75 million capex, and that ultimately bring that project into production maybe a bit sooner, and that will ultimately help us as the off-taker of the material. So I think this is a very good cooperation, and a cooperation that that's ever deepening.
Bram, given it sounds like I'm going to interview you now. Given we you work and live and breathe the uranium market, do you just want to give the audience your view on what Sprott sort of positively brings to the uranium market?
Yeah, absolutely. Bit of a different question, but yeah, so since August, for people who haven't really fully looked at the uranium market, maybe just a background. So Sprott, the physical Sprott Trust for uranium, is an entity that's taken over the old UPC entity in Canada, and the entity is its main goal is to stack uranium and buy uranium from the market as investors pile into the facility. And so they've they launched it sometime in August, and they, more than anybody could have expected, have taken out about 20 million pounds already in the last couple of months out of the spot market. And what it really does to the market, and which is important, is it gives some sense of price discovery, because what we see right now, there is a constant bid in the market, there's a constant buyer in the market, which is illiquid at best. And so what it really does, it shows market participants like ourselves, but also the outsider investor community, where and when the price is on a spot market basis, how much of an overhang there really is in that spot market from previous periods in terms of inventory, and where the price formation should happen. And Sprott has done an incredible job in that respect. They've, as I said, they've bought about 20 million pounds, and they continue buying as and when investor demand comes on. And so that's it's a change and the different dynamic in the market than what we've seen over the last 5 years, where we really see a motivated buyer that's continuously there, and that really is driving that price discovery in the market.
Well, that's handy. Okay, well, I think that's all I've got, Jane. If you want to start asking the questions, I think we might have.
Yeah, perfect. There's actually been quite a few questions that have come through, so I'm going to try and bring them all in together. Pete, this is one for you. So if Aura was producing at current uranium prices, what would the cash flow look like? And then further to that, if the resources expanded to 3 million pounds, what cash flow would the company be expecting then?
Yeah, look, at the study price of $60 a pound, Aura produces around about 25 and 1 million pounds per annum. Aura produces around about $25 million of after-tax cash flow. And after-tax cash flow is a number I always like to focus on. If we were to expand it to 3 million pounds, it's in the $90 to $100 million area. And obviously, that would go up exponentially as we see prices anywhere greater than that 60 level.
Perfect. Again, another one for you, Pete. So why is the CapEx low for the project when compared to others?
Look, it's so multidimensional, but it comes down to the beneficiation, which my geos hate the fact that I call it dumb geological luck, but it is just that, means that we have a beneficiation step. It removes a lot of material. And when it removes the material, it makes the footprint of the plant smaller. It makes the fact that the capital, therefore, for the expensive parts are very, very low. So it's a natural consequence of that fine carnotite, that and also the fact that it's soft and friable. Soft and friable means there's no drill and blast, means there's no crushing and grinding. As a metallurgist, you know, when you say no crushing grinding, one, it means I don't have to take those huge crushing units and grinding units into the desert. Then I don't have to take 15,000 tons of cement out to base them on. And then I don't need to take huge generators out to turn the grinding machines and the crushing machines. And then I don't need to get the diesel delivered to drive those. So it cascades all the way through, but it's very, very beneficial to us.
Okay, so another one. So how is the company's relationship with the Mauritanian government and the local communities?
Yeah, look, we've got a great relationship with the government. We've been there for a long time now. We have 3 people and a small office there in Mauritania. Our man, Sid Ahmed, used to work in the department, and he knows everybody. He literally camps out there every day. I've met the minister there a number of times. We've met the president at different times. It's a good mineral act. We negotiated a very good arrangement on the royalties with the government, and the government's always been very keen to see Aura get out there and get this production underway because it's a developing country. And they've also got great relationships with the US government, who built a $300 million embassy there a couple of years ago, and the French, it's a former French colony embassy as well. So Macron visited 3 to 4 months ago. We believe they want to demonstrate to those allies that they are building the economic prosperity of the country, that their people are getting well looked after. So they're very keen to see us get this developed. And interestingly enough, they're very interested to see this part of the Sahara Desert developed as well. They want activity out there. They want people traveling to these areas. Obviously, it's good for everybody and the local regions. And I will just say, close by, 600 kilometres, which is pretty close by for us out there, there is a town called Zourat. Zourat's the home of the national iron ore miner. They produce 12 million tonnes, soon to be 20 million tonnes of iron ore per annum. It's been there since the 70s, and then there's a 1,000-kilometre railway line from there to the coast. So we've got a lot of mining infrastructure, mining thinking people in the area. Building a mine's not new to these guys. They're very au fait with it all.
Thanks for that, Peter. And you did mention vanadium credits in there as well. So can you please explain the benefits of having vanadium as a byproduct?
Yeah, it's a bit weird to have vanadium as a byproduct because, as many of you would know, we have a vanadium project also up in Sweden, which is a fantastic product, and we're going to talk a lot more about it in the future. Vanadium gives you hopefully in the future, a vanadium redox flow battery, which is much better than the big batteries we've got in Australia, doing pretty well nothing for the grid. But a vanadium redox flow battery gives you grid storage. And we have found that we do have quite an amount of vanadium in the project down there. So it could be quite a substantial cost reduction just having that vanadium credit. Vanadium, as you know, went up to very high prices, $33 a pound for vanadium pentoxide a couple of years ago. It's now around about the 10 mark, but even at 10 gives us a substantial kick in the cash costs. So it ties our Swedish project together with Tiris because we'll probably be able to market the vanadium in the same place. But it's very handy. We've got some smart people working on the project. Will Goodall does a lot of our work on this, and he picks up all these things very clearly and easily. So positive.
Again, another one for you, Peter. So how is the company progressing with its plan to become a net zero carbon emissions producer?
Yep, as I said in the presentation, we got Wood PLC out of South Africa to do a study. We now, just in receipt of the report, we're a very, very low emitter of carbon, and we will offset that very easily to become a net zero emission producer of uranium, and that should be released soon to the market. So we're in good shape there, and as we expected with the things we're doing, we're going to use some solar power, we're going to use some wind power as well. We don't have a large workforce. Again, all the benefits we've had of being a small project are going to drive also this very, very low emission status.
Thank you. And we've mentioned that the CapEx is 70 mil, for which we've got the 20. So where is the remaining 50 coming from?
Yeah, look, there's a whole package of finance to be put together. We really want to have that whole package of finance in place before we kick off. It'd be not wise to kick the thing off before you had all the money. And that's why Bram and Curzon's portion of this funding is very, very important. And it also gives a very good signal to other debt providers that we've got a good partner and he's a long-term partner, and gives confidence to the project. So there will be some debt, more to go in the project. There'll be small portions of equity in the future, but nothing, at this price, we believe we're still very undervalued. And as we demonstrate all these different building blocks in the project over the next period of time, we think we'll be in a better position to maybe get some small amounts of equity, but the majority of it will be from facilities like Bram's. And, we've got discussions going on right at the moment with people in London and other places where they're very willing to source and tap into what they're seeing as pretty active markets right at the moment for debt and exposure more broadly to the uranium cycle, because I think everybody's seeing the benefits of it. So that's probably where we see. I mean, everybody sees a small capex and they see a very doable project. It means we're going to have we're already having quite a few people line up and want to talk to us, because it's not an onerous financing. It's not 300, 400, 500 million, which is what you need for some of these projects. Okay.
Well, just further that then, Peter. So when do we actually plan to start spending that 20 mil? Is it Q4 2021 or is it early 2022?
I think what we've got to see, I won't necessarily give a date because that would mean I've got a crystal ball and I don't have one. But I think we have to see a good stable uranium price. We as a board have got to sit down and say, are we at a point where we feel confident we can press ahead? And are we at a point where we've got a very clear picture on all the financing for the $75 million. So look, I think it's not out of the question that we could be in that position in, within 3 to 6 months. Sooner the better. And we will work to try and get there as soon as we can. But yeah, no crystal ball dates, but that's the sort of shape of how we will look at it.
Sorry, another one for you, Pete. Bram, I will get to you, but can you please discuss the water source at Tiris, and is that source of water going to last the entire life of the mining operation?
Yeah, look, it's just been fabulous. Well, I keep on sitting here at night and I get these great videos that then I share with the whole team, and hopefully we can post some of them. But they've been really, really strong water results in several holes. We only need 0.2 of a gigalitre of water per annum to as make-up water in the project. So right at the moment, we would believe we've got far in excess of enough water to, it's got to be a few more tests to determine this, but we would feel right now we've got enough water for the project life as we stand now. We also have a very, very strong backup plan for water. It's something called the Tayadini Basin, which is the Mauritanian equivalent of the Great Artesian Basin. And that's essentially unlimited water supplies about 100 kilometres south of us. And, some very big iron ore producers have tapped that, and we're planning to tap that for large, large quantities of water. The reason we didn't go to the Tayadini is we wanted to go closer to the project site to keep the capital down, and that's worked. So that's where we're going to rest with the water. But if we ever have any big expansion that we can't get enough water, we've got the Tayadini Basin there, which would take the capital for the water to from say 5 million up to about 14 million. And we'd rather keep that 9 million ourselves just now, but that's the reason why we left the Tayadini for now. But it still sits there as an absolutely unlimited supply of water. So yeah, we feel very confident with the water, and we'll release some more stuff to the market soon, so you can see why we're so excited about water in the Sahara Desert.
Thank you. And Bram, some for you now. So I know you've touched on this already, but I'll jump into it. So what was it about the Tiris uranium project that compelled you to enter the offtake and financing agreement?
Yeah, so we as a physical trader of the underlying commodity, what we really look for is projects that can go into production in the near term, and because ultimately our driver is receiving some physical material that we can then trade on and that we can do stuff with. And so we look at projects on a variety of metrics, but I'll just name a few. Like near-term production capabilities, an interesting resource base that's easily to be dug out, or that's easily to be explored, a low enough capex that we can see it conceivably being financed in the near term, an operating cost that is somewhere in the mid tier of the pack or a low tier of the pack, that will allow for the production to keep flowing even if the prices fluctuate a bit, which it always does in an illiquid market like uranium. And then obviously a jurisdiction that's important. We've seen a lot of projects fail on jurisdictions and licensing issues, and so we are as a company very confident and very happy with African jurisdictions, especially in that part of the world. We've got great experiences with uranium in that part of the world. Niger is only a couple of countries away, and we know that Mauritania is a very pro-mining country with the right frame set and the right mindset to bring to be the newcomer country in uranium. And so therefore we see Mauritania actually as an asset rather than as a difficulty, especially if you compare to like Europe or some other Western European countries where licensing and bringing uranium projects online is definitely a more difficult thing. And so as a variety of things, we see Aura ticking a lot of those boxes, and I think for us that was the real reason that we looked at the project initially. We liked it, and we went ahead and signed the offtake agreement and now the finance agreement.
Thank you. I know you touched on this earlier. However, can you please talk us through the uranium sector and where you see the market going?
Yeah, absolutely. The uranium sector is a sector that's been unloved for a really long time, and it's only recently changed. And Sprott has had a lot to do with that, which is what I explained earlier to Peter. But the fundamentals in the uranium sector have been there for a long time. We're currently coming out of a bear market that's basically set on since Fukushima. So we've been 10 years on, but the fundamentals have shifted much earlier than what we see today. We see a lot of demand coming online in the next 10-15 years, and we're always talking long-term time frames in uranium, because it's a commodity that requires planning for a long term. You don't build a nuclear power plant in 2 or 3 years like you do with a gas plant maybe, but we see the fundamentals being there. China is making a very big push for new reactors. They have been, but they've reiterated that in the latest 5-year plan. We see a lot of other countries making pushes for nuclear. India has publicly stated so. Russia is developing a lot of plans, both domestically but also as an expansion policy. And then we see a lot of newcomer countries. And what we've seen recently is that the energy crunch, especially in Europe but also in the US, has really added fuel to that fire, where a lot of countries were anti-nuclear, especially in the West, or at least were trying to phase out their nuclear power programs. We see a different narrative right now. Maybe Germany is a good example. Germany is phasing out their latest plans in 2022. I don't particularly think that Germany is going to come back to nuclear, but at least there's no voices in the both on the government level and in Germany as a country that nuclear should be a transitionary solution to go to net zero. And so on the demand side overall, it's a beautiful picture. Same with Japan. Japan has shut off all those nuclear power plants after Fukushima. It's taken a very long time before the first plants came online, and it sort of stalled a bit. But now with the new prime minister, who's again publicly stated that Japan wants to restart most of their power plants and potentially even build new ones if needed, that's a really big endorsement for nuclear. And then the other side of the coin is obviously the supply story, and the supply story has been a difficult one for uranium. With the bear market, especially the depths of the bear market in 2015, 2016, a lot of projects have gone on care and maintenance because of the low prices, and there has been a very long period of time where there was an underinvestment in uranium and where projects just weren't moving forward. There was some consolidation, but projects weren't moving forward. And so what we see now, and the recent price spike, and what we see now happening in the market is that supply demand playing out. We're currently sitting at a supply demand in the market where we're already undersupplied. We've got about 120 million pounds primary production. We've got about 180 million pounds primary demand. That gap over 60 million pounds is currently is bridged by secondary supply sources, which is supply sources of underfeeding and re-enrichment, but also inventory. And so we've seen inventory being drawn down a lot over the last couple of years, and we all know inventory is a finite resource, so you can't keep drawing down inventory. And so unless we see primary production going back up to a level where it can balance out the demand side, especially moving forward, we're gonna have to see either higher prices or projects coming online, and probably a combination of both. And so that's something that we currently see playing out. It's, as with everything in uranium, it's long lead times, but we see it playing out with the recent increase in spot prices, also the increase in the long-term pricing. And we definitely see that the gap also widening. The WNA recently issued their latest report in September, and that shows the gap is widening in the late 2020s and the 2030s. And so I think the Kazatomprom have publicly stated that we're going to need at least another Kazatomprom, which is the biggest supplier in the world, in the late 20s to really fill that gap. And so there's a real need for new projects to come online, projects like Aura, who can really fill that gap.
Well, just further to that as well, Bram. So what are your experiences in the previous uranium boom, and what similarities and differences are you seeing compared to the current market?
So there's a lot of similarities, also a lot of differences. I guess the main similarity I see currently compared to the previous price spike in 2007 is in 2007, the price went up on the premise of what we call the nuclear renaissance at the time. And nuclear renaissance was the sort of fact that the whole of the world was going to go build new nuclear reactors and really use nuclear power as the sustainable building block for their energy systems. And that's something that we see coming back at the moment as well. Nuclear has been unloved for a long time, especially since Fukushima. But with the energy crunch and energy politics taking front and center stage right now, we see that nuclear power is firmly back on the agenda, that a lot of countries have put nuclear up there as their baseload requirements producer, supplemented by renewables. And I think the world is now woken up to the idea that nuclear actually should be playing an important role. And we see it in all sorts of technical IPCC reports and whatnot. And we see it in countries publicly endorsing nuclear. And so that's obviously a big similarity in the sense that nuclear is loved again and that the public opinion towards nuclear is changing. Other things that we see as similarity is that we're coming out of a 10-year time frame for an underinvested sector. That was the same in 2007 when there's been underinvestment for an even longer period of time, 15, 20 years at the time, and it had been unloved. And so that put us up back then for a real big rally in prices because there wasn't enough projects that could come online in the near-term future. And some other projects that were supposed to come online, Cedar Lake and MacArthur River, both had issues with flooding and whatnot. And that's what really caused a spike in 2007. But I think it's also important that we highlight some of the differences between then and now. I guess one of the key differences is that because the uranium pricing and the uranium market have been such an unloved child in 2007, nuclear utilities had very low inventories. There's very low inventories knocking around the world. And so we came into that 2007 price spike with a market that was that just didn't have enough material. And so there was a really imminent need for material with the nuclear renaissance happening. That's something that's a bit different right now. Nuclear utilities have gotten a bit smarter and are less complacent. And we see utilities and inventories still being part of it, but that's not necessarily a bad thing. We think what caused a real run up and spike in price rather than a sustained price level in 2007 was the fact that we needed a lot of material all of a sudden, whereas right now we see it more being a gradual price increase, which is good for projects because you want a longer term pricing that's accretive for investors and that's accretive for projects. Another big difference that we see now as well compared to 2007 is that we're now looking at a 10-15 year time frame where there is an undersupplied market, where there's a big supply gap, and we don't necessarily know where it's all going to come from. Even if you tally up all the projects that are supposed to come online or that could potentially come online, you still have a supply gap in the 2030s, and that needs to be addressed. That's something that wasn't the case in 2007. In 2007, the supply-demand model looked actually less dramatic and looked like there was enough supply. It had a bit of a setback with MacArthur River and Cedar Lakes going offline for a while, but that's not a big difference. And I think that's a reason why we potentially see the uranium price staying higher longer. Maybe not with as a dramatic spike as we saw in 2007, but if we definitely see a price, especially a long-term price that sits in the 60s to 80s, maybe on a longer-term basis.
Just further to that, so with the recent uranium spot price increase and relative pullback, do you see utilities entering the term market, and do you see them behaving differently as opposed to, say, 6 months ago?
Yes, absolutely. So utilities have obviously publicly stated that they're not particularly worried about the price spike and the supply-demand models. Utilities, as I said earlier, they have some inventory on hand. They are relatively well covered, but that's what they say publicly. And what we see privately, and what's also been echoed by some of the other bigger producers like Kazatomprom and Cameco, is that a lot of utilities have come to the table in a bigger fashion, and that they've gone, okay, guys, we have supply contracts with you guys. Can we extend them? Can we renew them? Can we look at new contracts? And what we see utilities now really doing is talking to their producer base and potentially new producer base, and looking at what is possible on signing new long-term contracts. And when I say new long-term contracts, we really look at the sort of the 25 to 2030, maybe in 2035 timeframe, where they're very, very little covered. Most utilities are very well covered until sort of 2025, or don't have a need for a big chunk of material. But past that, there is definitely a need. And so utilities are they're short, whichever way you turn it. The utility is always short because there's always need for uranium. No utility has full coverage for the lifetime of the plant. And so we do see utilities coming back to the table. The other thing that's really important in that respect is that we see the long-term pricing, which is ultimately what utilities look at when they contract, or is the pricing they're supposed to get, and the pricing that miners get is had a massive tick up. It went from sort of $35 price range to a $45 price range, which is reported by some of the price reporters. And that is a real testament to the fact that utilities are having those discussions, are signing those contracts at elevated prices. And that really shows that they are coming to the table, that they are looking at signing future supply contracts, and that they're willing to pay higher prices than they were 6 months ago.
Okay, so just onto the commodity price. So in the past, we've seen commodity price overshoot. What do you expect to happen if this would occur with the uranium price?
I think I touched on it like briefly earlier. I think there is always a potential for commodity prices overshooting, especially given where we are currently in the market, with there being a motivated buyer in the name of Sprott. If there is enough investor demand pouring into that vehicle, they have to buy. There's no two ways about it, and I think that could potentially cause a big spike in price again. However, if we look at the long-term fundamentals, we do believe in a more sort of gradual increase in pricing and a uranium price that settles at a higher level because of everything I've said earlier with what we see in some of the, like, the fundamentals, the supply-demand models, the coverage, the inventory levels, and that sort of thing. So we don't predict the price to spike and fall straight back down. We predict the price to more gradually settle at a higher level. And especially an indicator to look at is that long-term pricing that I mentioned earlier, because that really indicates where utilities are contracting and what they're willing to pay for uranium.
And so what spot price do you expect uranium will need to rise to allow projects to move into production?
That's a bit of a difficult one because there's obviously a whole range of projects and spot prices. But I think for the spot price or the long-term price to get to a level where there is enough production going forward, because there is enough resources in the world, that's not a problem, but it needs to be incentivized to come online. We will look at a price that's into the 60s, 70s, $80 price range, and it has to stay there for a while. So projects have the time to go into development, to sign those contracts, to get their debt finance or equity financing into place. And that's why it's also important that the price just doesn't spike and then fall straight back down to earth, because it's, again, maybe coming back to an earlier question, it's something that we saw in 2007 where the price did go up to $140 per pound, which should theoretically be enough to bring a whole range of projects online. But because it came down so quickly within a year and a half, ultimately in the last bull cycle, we saw 3 projects come online. We saw Cameco bringing a project online, we saw the Kazakhs really ramping up, and we saw Paladin bring a project online. And that was about it, of a range of maybe 30, 40 projects that could have come online theoretically. And so it's really important that you keep an eye out on what's, like, where the price settles for a long time, the long-term pricing. And I think that's where this price rise might be slightly different. But as I said, who knows with the with Sprott? It's a small market that's about between $6 and $8 billion worth of material coming out of the ground each year. And so $1 billion or $2 billion of investor capital that flows into the space could really, really change that dynamic. But that's not for me to comment on. That's just an observation I'm making.
Wonderful. I think that's all we've got time for today, Bram. Thank you for joining us, and Peter as well. And thank you all for joining us today for the Aura Energy Investor Webinar. A copy of today's recording will be available on the website in the coming days. And should we have missed any of your questions, please feel free to reach out via the contact details on the bottom of our ASX releases. We look forward to hosting you again soon.